So hello everybody, we have another panel today. It's about the harmonization of rules, so it's about regulation again. I am from the Boston Consulting Group. We are also seeing the topic quite intensively since we are discussing regulations, not only with regulators, but also with a lot of banks and crypto native companies. And especially over the last 1 or 2 years, there have been so many movements, so many developments lately that because it's such an important topic. People see risks, people see things that blows up, yeah, and that's why there are many new regulations coming out now or soon or have been launched already. I'm happy to welcome a very good panel here. Maybe if I ask you to quickly introduce yourself and the company you're working for, and how do you see the topic harmonization of regulation for you, but also for the industry?
Yes, thank you very much for having us today. My name is Oliver. Like you can see on the screen, I am the founder of GrizzlyFi. GrizzlyFi was the biggest IDO that ever happened on the BNB chain with $26 million in under 3 days. Now we have roundabout over $100 million total value locked after 1 month of existing. So I'm representing the true DeFi part, I guess, in this discussion. And for me, the harmonization of regulation or harmonizing rules of engagement is a very difficult topic, because I think from a true DeFi perspective, from a project's perspective, on the long term, it's an unharmonizable way where it goes. I myself, as a DeFi enthusiast and as a DeFi project, believe that there won't be any true DeFi projects in the near future anymore, because the regulations right now are moving towards a more centralized way. Everyone wants to know the KYC, KYB of the clients, and it's moving further and further in this way. And the projects and especially the people from the industry, the real crypto enthusiasts, are somehow holding against it right now. But I myself believe that in the future we will see a huge move towards centralization and towards full regulation of DeFi, of crypto, of the metaverse, of whatever topic is happening in the world.
Thank you.
Hi, everyone. Yeah, thanks for having us. Thank you, Vara, for having us. My name is Clayton Leslie. I'm head of business operations at Anchain AI. We're a technology provider. We use artificial intelligence to create risk scores for wallet addresses that exist on-chain for multiple blockchains. And then those risk scores are used to do AML, to understand the risk of a VASP. And we also handle smart contract-focused investigations. We do work with regulators in the United States, Vara itself. And I think over the last year, we've seen, well, last 2 years really, we've seen some clarity come out as far as regulations in a couple of regions. Vara is one, and Singapore, I think, would be another. And other regions, not so much. I don't want to speculate too much on my home country, for example, but we're starting to see litigation against certain types of crypto-focused entities, DAOs, for example. We saw the first sanctioning of a smart contract. So regulations are getting closer to the technology, if you will, which is complicating things, I think, right? But I'm not here to speculate on where regulations are going necessarily, but I can talk about what I think based on what's occurring and you know, what we can do as technology providers to help facilitate where things do end up going. So I'll pass it to Ryan.
Thank you. Hi guys, my name is Ryan. I'm the strategy investment of KuCoin. So specifically in KuCoin Labs, and where we see DeFi, as in we look at lots of projects. We understand that lots of, you could say, innovations are coming in for people to go into the space, and of course try to make yield out of it. If you look in terms of the CeFi structure, as in all the exchanges, we all do these kind of products because ultimately we want to get yield, and that's what you bring in you could say, the community, and of course investors to come on board, be it retail or institutional. In terms of, you could say, the harmonizing between retail and institutional investors, you would actually see a trajectory, or rather the movement has changed from a retail perspective, where we all general retailers used to play in DeFi. But as the market goes down, you can see that the switch or the movement has actually moved between traditional retail to institutional institutions that are trying to come on board this blockchain space. Banks, hedge funds, and of course FIs, they come in knowing that the fact that you can actually gain market share. And as we know that when retailers feel that there's a market movement shake on the bear market, we try to pull out funds. And when we pull out funds, this actually creates a lower equilibrium of the price of how DeFi can actually provide yield. And that's when the institutional, I would say, value whales come in. So when you want to try to harmonize it, it's going to be quite difficult because you have two kinds of like shifts between the retailers, average Joes like you and I, and of course the institution side of things. To actually try to harmonize these kind of momentum, we have to make sure that the market actually reaches an equilibrium where the bear market starts to rise up, when interest rate starts to go down, and then everybody tries to capture a normalized yield. So that's how I see that we try to face this kind of harmonizing effect. If we say in the future for the institutional side of things to actually produce products like what the CeFi companies are actually doing, yeah, you can see that kind of tandem switch. And I do hope that you could say the retailers actually benefit out of this instead of the big volume movers, because banks, ultimately, you have the cash to get onto the space. And that's how I kind of see the switch between traditional retail investors like you and I towards a more institutional space, because ultimately you sell your products or whatever savings you are, you're putting it into a bank, and the banks are eventually going to provide you products which are quite similar than what you have already known in the DeFi aspect of a traditional blockchain ecosystem. Yeah.
Thank you.
No worries.
Hi, I'm Elizabeth Matthew. I work at Consensus. We are the largest blockchain software company. We have primarily two business units. One is our developer-focused business line that has tools such as Infura, which is a SaaS offering for developers to access and be able to build things on the Ethereum and EVM compatible ecosystem. It is used by 500,000 developers worldwide today. And on the other side, our second business unit is primarily what we consider our user business line, direct user business line. And in that, we house MetaMask, which is the world's most popular Web3 wallet, used by 30 million monthly active users today. I represent personally MetaMask Institutional, which is our newest offering in how we enable organizations have access to Web3. And we do this in a very particular way. In our North Star goal of how we think about bridging every organization on the planet to Web3, we fundamentally believe that we need to have a wide range of custodial stacks that provide the multi-user access, operational controls, and compliant frameworks in order to access Web3 in the same unrivaled way that we provide access to through MetaMask, the retail wallet, but yet in a compliant way with the operational controls that organizations require. The kind of organizations on MetaMask Institutional vary from a publicly listed company that wants to get involved in NFTs or fungible tokens in how they think about engaging with their community and thinking of new ways around fan engagement, to crypto funds that are active in DeFi markets, some of them accessing this programmatically, to then treasury funds that might find themselves with token portfolios but want to have a operationally secure way of managing that portfolio. So given that we have organizations globally wanting to access Web3, we are intentional about being an aggregator across various custodial stacks to do this. And in keeping in line with the discussion on the panel, I would say that I think we're still really early. And I think if we took an approach that tried to fit DeFi and Web3 in the same constructs following the same security laws that were developed in 1933 and 34 might be the wrong way and might stifle the innovation that we are seeing on hand. And so we absolutely understand that you need to have regulatory clarity in order to safeguard retail interests in how we look at Web3. Much of the rules around investor suitability really go back to the level of disclosures that we expect of entities that are purveyors of risk. And so when you think about this new asset class and this new technology, I actually think a bit different in that you do have the analytics for regulators to get much more granular in how we assess systematic risk, both at the retail and institutional level. The tech is absolutely there, by solutions like you're building. We have our own in-house capability that enables you to screen for counterparty risk exposure on a pre-trade basis as well as on a post-trade monitoring basis to give you the deepest analysis of the kind of transfers you might be exposed to when you're interacting in Web3. So I do think that there is a happy medium where you can continue to be decentralized, use the technologies and the analytics that just having an on-chain global settlement layer affords you. But we're still extremely early, and I think there's a lot of education that needs to be done with regulators as well as large entities that are capital allocators and portfolio managers. And in the meanwhile, in many of these discussions, and these have kind of become more, have come up more in this cycle that we're in, the discussions that we're having are certainly skewing towards institutional. One thing I see is that there is such a big gap between a theoretical understanding of the technology and a practitioner's view of what can be done and what still needs to be solved for. And so we at MetaMask Institutional tend to advise practitioners and regulators to really create a sandbox environment and actually get involved in Web3. It is a steep operational learning curve. It is an asset class unlike any other. And you're dealing with a payment rail that combines identity and data natively. And so one can create frameworks, regulatory or operational frameworks or governance frameworks, but many of what I have seen tend to be somewhat theoretical and lacking a practitioner's point of view.
Then thanks a lot for this great round of introduction. What I would love to do now is to get to know you a little bit better and further and your points of views. So I'll ask you two questions now, and to have an overview, maybe you'll do something like this one. Yeah. So thumbs up is yes, you're totally in favor. Thumbs down is not at all. Yeah. So first question, and this is also maybe good for the audience because they see just looking at you, what are your points of views? So first question, what is our topic? So do you think that harmonization of the regulations is a good movement or not? I mean, it's happening like in US, like in Europe, there's really harmonization of the regulations at the moment happening. Is it good or bad?
Define harmonization for everyone. What is harmonization?
Yeah. International harmonization or local?
Good point. Let's start with regional harmonization, like when you look to Europe or US. Okay. International harmonization. Okay. Good. Then second question, and it's coming back to what you said in your entrance statement. Are regulations killing the business, or are regulations helping the business to get out of the gray zone for one particular region or one particular country? So regulations are helping.
Regulatory clarity, I think, is certainly helpful.
Okay. So thanks a lot. I hope this helped the audience. Yeah. Then I would come back again to what you said, that because of various regulations that we see out there now, there is no way to really come up with a new true DeFi project. So maybe you can elaborate a little bit on that, because various investors are betting on a second DeFi, peak.
On a second DeFi summer, yes. That's a very interesting question, because what is true DeFi, True DeFi in its core is pure privacy. True DeFi in its core is pure controllessness, I would say, in some way. And it's very contradictory to any kind of controlled environment, to any kind of regulation. So true DeFi isn't existing inside of any regulation at all right now. It's all about privacy. It's all about not getting... it's all about security. It's all about personal data. And at the other part, it's very difficult for the DeFi people themselves to move around in the true world. Because if you want to spend some of your DeFi tokens wherever you found it, right now you find yourself in a transitional space where you either go with the regulations. That's why I always say that I prefer harmonized regulations, understandable regulations globally, because there is literally no way anymore right now to, for example, get in or get out of Bitcoin decentralized without stepping into a crime scene, Either you're money laundering or doing whatever, or you're compelling with the regulations, with the KYC, KYB compliance, and you're doing it the clean way over OTC, over a centralized exchange, over whatever place you happen to go. But it's no more DeFi. And I think we are in a transitional phase right now where like the last true DeFi projects start slowly integrating into the whole centralized financial space. And I think it's good because it's finally opening the doors for mass adoption. I think crypto and DeFi as a technology is still much safer, much easier, much faster, and much more efficient to use than like the traditional banking applications that are running on servers. I think a combination of both will be somehow the future, and I believe in CeDeFi, and I think we're in a transitional phase right now already, because like I already mentioned, even now you can't get in or out of Bitcoin, of the most decentralized currencies in the world, without getting doxxed in some way or without being criminal in the other part. So that's my opinion on that.
Thank you. Maybe I can hand over to the others.
Yeah, so I think to echo Oliver a bit, we're hitting a peak in the development of decentralized finance where the ethos that originally shrouded it, being decentralized, is starting to fade away, right? I think that when you have what's essentially a large-scale open source project that's touching payment rails, creating new classes of assets, and then touching traditional assets as well, it's not going to exist in the form that it started, right? And this is something that companies like MetaMask have done a good job of positioning for, and it's what we're trying to position for as well. When a DeFi project can take cues from regulators, despite sometimes vague cues, and then develop their products accordingly, they tend to come out ahead. So I don't see that trend stopping anytime soon, and for what it's worth, that might mean that the ethos of decentralization's falling away. I don't know how true that is, but it's a feeling I have. At Anchain AI, what we're trying to do is enable those decentralized finance projects, the smart contract projects that are positioning for regulation. So we're providing smart contract tools, free APIs for developers that can take advantage of our data at the chain level, and for better or worse, screen participants in their platforms such that that platform can comply with the majority of regulations as they currently exist. So, maybe Ryan can talk about how he prioritizes investments at KuCoin, but I'm in the thought that the more a decentralized finance project positions itself based on these cues, the better off that they'll be in the future as far as scale and growth.
So then I hand over to you, since you had your thumb down before. I'm really curious about your what you say now.
If you look at the whole, you could say, development of crypto and what it means for crypto, it's supposed to be decentralized. And of course, as an exchange or when people dabble in cryptocurrency, it's all about the sentiment of a human, right? You go into a new asset class hoping to earn something more than what you can be offered in a traditional kind of finance. So that's what builds or increases the flow of moving towards that kind of DeFi project, trying to gain yield in how you basically like stake, all these new terms that come on board, which it's very exciting for youths and of course for people in general. But the thing is, when the psychology of a human, or like when we are all excited to try something new, switches based on the fact of market shifts, then why would you want to plug your finances out from a DeFi project and then put it back into, say, a TradFi? So everything is about comfort and security. Yes, I would say that there's a big difference between TradFi and, of course, DeFi. But I think it's also based on how you actually perceive the kind of industry that we're in, and, of course, how you value your worth. Basically, it's your dollars and cents that are going in. If the bank is giving you a higher yield, you put your money in the bank, right? But you do understand that regulations are created by the country to make sure that it actually protects the citizens as well. So that's why you have these kind of like TradFi regulations on board. But if there's a shakeup within the industry of that country, centralized kind of governance, you want to find ways to park your money elsewhere. So you move into either a CeFi or DeFi, because you feel that your value of what you have is actually fluctuating so much that you want to get something worth your dollar cents. So that's why I always find that when you try to merge between the harmonization effect of TradFi, CeFi, and DeFi, it's a really big gray area, because one is you want security, so you park your money in a bank. But two, you want to make more money, so you park your money in a CeFi or a DeFi protocol, because that's what you, as a human, psychology, you want to make it more valuable of what you have. So in an exchange, why you see most exchanges coming into effect, because you want to find a way that you can get your value's worth, your hard-earned money from whatever salary that you want. But then again, you have to be cautious, because when you put your money in stuff in like CeFi and DeFi, you're not protected, right? Because it is open source. It's based on a script. It's also based on a contract of how the programmers are done. So it's also your understanding of the protocols that you want to put your value in. Because we see so many projects coming into the space, but how do you value a good project versus a bad project? It's also ultimately the community's faith, which is why that's what crypto is. It's the faith of the people. And if you value that you could say ecosystem of the DeFi project or protocol, and you put your money's worth, and the community runs it in the DAO, or the way that they govern the project, or basically the DeFi protocol, then yes, it works for you. But it also depends on your risk appetite and how well you actually feel you want to invest in a project, whether it's going to go high or go low. It's the same as a bank, because you in a centralized form of governance or regulations, you're betting against interest rates, FX rates, inflation. But you have to also take into effect that these are also affected in the DeFi space. And how do you actually risk manage and risk mitigate your kind of wealth when you're putting money in either a traditional form or in a crypto form? Because it is you, and it's not, basically, it is not the governance of centralized exchange to actually protect you. And it's also not your government in terms of the way they put regulations to protect you. It's ultimately your choice. And you just got to find a way to risk mitigate so that you don't get burnt. Because anyway, if you put it in CeFi, DeFi, TradFi, you can get burnt, or you can actually make money out of it. So it's to better educate yourself so that you actually understand the harmony of these separate, you could say, financial spaces, and then basically diversify and choose which is best for you, not just put in one, because no one controls your wealth but yourself. Yeah, that's how we see it, or I see it.
Thank you.
Yeah, so I actually don't think that open source is less secure. I do think that it provides additional levels of transparency. If Credit Suisse's balance sheet was on an open source smart contract, I do think that you could have had less rumor-based speculation in the last few trading sessions. I actually think that so 4 years back, 5 years back, you had institutions that began with a centralized approach to exploring what this tech could do for them. We had private chains, permissioned chains as the foundational layer where which they were trying to evaluate certain use cases. That has completely switched the other way around, where institutions work with consensus very actively, and the conversation, it doesn't begin with quorum. It begins with mainnet, public mainnet, or a layer 2. ZK technology has advanced over the last few years that solves for permission, privacy, and scalability specific to various use cases. So I actually don't think that that more regulations means more centralization. I don't think that open source means things are less secure. I do think that you are afforded a level of granularity and analytics that regulators just haven't had access to. And it's about them getting comfortable and developing a practical awareness of the technology and being able to harness the power of that. I do think you were better off in DeFi than CeFi over the last 6 months. If you had a loan in Celsius versus a loan in Aave or Centrifuge, I do think that the chances of you making whole that loan would have been better off in DeFi than CeFi with opacity, where you aren't sure of the level of counterparty risk you're taking to avail of those rates.
Well, thank you. I might come now to the topic of licensing. You mentioned it already. So when we speak to regulators, we see that regulators have a difficult time to come up with what should be in the license and what shouldn't. Yeah. For instance, they're quite hesitant of putting DeFi into a licensing, because as soon as you do that, they're touching the topic of, is it now a bank or not? Yeah, because when we have a protocol where you allow investors to invest in this and then actually they invest in a mortgage, so is the protocol in between a bank or not? Yeah. So this is why, at least in my view, the reason why the DeFi topic is not touched yet by regulators. It might be also a topic what you mentioned, that they don't have they couldn't find the talent on the market. So it's actually sometimes also a knowledge topic maybe for some regulators. Of course, not all of them. Yeah. But if you reflect a little bit on this. Will there be in the future a license, like a banking license for DeFi, CeFi, what have you?
Yeah, I do think that it's worth relooking the existing frameworks and creating a license that is befitting of the technology and what exactly is being done, right? Yeah. So you have rules that were developed at a time when we were dealing with paper securities. If you look at the manual at DTCC, on the rules that decide how a coupon payment is made out on a bond, it talks about a paper-based security. And that's just like, it's a completely different paradigm when you're thinking about on-chain asset servicing of a loan. So it's absolutely, I think we would be much better off taking a first principles approach to understanding, the same principles of investor protections holds true. The same principles of not wanting to face counterparties that may be sanctioned or related to nefarious activities holds true. These are universally accepted principles, and it makes sense to be able to look at it from a first principle basis of saying, how do we make sure that we have the analytics to be able to make the right judgment and right decisions?
To go back to the decentralization versus centralization in the context of regulation one more time. I think that decentralization will remain intact to the extent that a regulator can accurately license a decentralized project, which is the challenge right now. How do you regulate and mandate a project that fundamentally exists on a group of smart contracts developed by asynchronous developers across the world who may or may not actively, be a part of a foundation or a group that markets that collection of smart contracts? So as the regulatory framework develops with the technology, I think ideally we'll start to see clarity around those two subjects, which Elizabeth just touched on. But the closer the regulation can get to the smart contract level in terms of defining how that smart contract exists in terms of a financial system, then we'll start to see real clarity in terms of DeFi.
Yeah, and we certainly have projects coming up that are built institution ready from the ground up. Not built first for permissionless retail, but are built institutional first. And so I do think that we're going to have more clarity. I mean, we speak to those kind of protocols all the time that say, I have only institutional participation in this protocol. How do I get involved? And that's where MetaMask Institutional comes in. So I do think that you are going to skew towards institutional participation in DeFi models, because I think it's still very early to say which use cases or which asset classes are better served using DeFi. I think there's nothing wrong with the bond markets and stock markets the way it is today. They work fine. I don't think those are the use cases that need DeFi, to be honest.
So I have always the question for this topic: if you try to regulate or to build a regulatory framework around a DeFi project, there are two possibilities. Is it truly regulated? So does the regulation work? Does it have its use, so it can control something, so it can maybe write some penalties if they don't comply with this or that? Or on the other side, is the project still DeFi then? If it complies to the regulation, to the law probably, or to something else, because as soon as you don't do KYC, you cannot talk about regulation. It's literally not possible in the current stage already. It's just being respected somehow. It's not being truly regulated. But after you do KYC, after you comply to this regulation, you're not DeFi anymore. So that's why I think there is no such thing as a regulatory framework for a true DeFi project. It's always is it DeFi or is it regulated? Or is it just respected? That's the way in between that I see. Maybe it will be just respected by the regulators like they do it right now in many places. In many places, they just say, all right, in a DeFi project, you don't touch the money yourself, so you're somehow not a bank. You can't touch the money, so you're also not a custodian, not any type of other financial license. You're just a software development company. For example, that's how they do it right now, and I can't say for sure. Either it's going to stay the same way, or it's moving towards KYC, KYB, but then it's no DeFi framework anymore.
So you're basically saying that DeFi regulation is a contradiction on its own.
Yes. DeFi regulation is a contradiction on its own, because as soon as you comply with this regulation, as soon as you follow the rules, you're not following the rules of the community anymore. Or on the other side, if you want to follow the decision of the community through governance, through whatever DAO technology, how should you comply with the regulation? If the regulation says you're not allowed to do that, but at the same time the community says yes, but we want it, what do? As soon as you do what the regulator expects you to do, you're not DeFi anymore. As soon as you do what the community expects from you, what happens then? You go to jail, or what is happening then, you know?
I actually agree, because you go back to square one with the great divide between people or regulations. And if traditional institutions are now trying to move into the DeFi space, it's because they're moving towards a new asset class of trading. Because you used to do bonds, stocks, and then all these institutions are now dabbling in crypto, which is somewhat like a new asset class, which is similar to FX. So once you put regulations, the customers will be very different. It'll be institutional finance customers, high net worth, family offices, hedge funds, versus the people that want decentralized finance so that we can trade with comfort, knowing that there's security, there's some way of anonymity so that we can all be sure that no one knows where the funds are going. But it's a gray area because, like I said earlier, it's all about your identity, right? If you're moving towards TradFi, it could provide you with a higher yield, but basically people want to know where's the money coming from, or regulations. If you put your money back into the bank, a spike in 50K creates question marks. Even right now, if I give you 50,000, you bank it, where's the money coming from? So that's why you have these regulators wanting to know where these funds are coming from. And like the great divide comes back again, because the question is, whose money is it? Is it yours to be played around with wherever you want to do? Or do you go back to the government wants to use your money so they can enhance GDP? Basically, it's a revolving around of funds. So regulations goes back, and once it hits into, you could say, DeFi, institutional DeFi, it's just a different side of asset class governed by institutional finance. That's my kind of view.
Please, sir.
But you can ascertain if the source is clean without knowing your counterparty, right? You can do KYT screening. You can do OFAC screening. Like you can screen a pool, and using AI ML tech, you can absolutely get a counterparty risk score of a pool and all the transfers that have been associated with any address that has interacted with that pool on a pre-trade basis as well as a post-trade basis. So I don't like, we do have the tech that enables a way to be able to quantify credit counterparty exposure without identifying, the source of it. So we already have tools that many organizations on MMI use today to do KYT screening with the 5th AML directive in EU that says you need to know who your counterparty is. So you could have already put your settings on our platform in a way so that you are not associated with any mixer. You're not associated with any OFAC sanctioned related transfers without knowing who your counterparty is. So the tech exists. I think it's very broad to say that all regulations lead to the need to identify. I think there are all kinds of regulations that adhere to counterparty risk and consumer protection without getting bogged down by KYC. That's step number one. Step number two, how do you think about decentralized identity? And this is something that we're actively working with several identity providers to create a scalable on-chain solution that can transfer across various protocols. So you're moving from a paradigm where you could have had access to financial engineering from maybe a top 50 investment bank. And you go through the onboarding process of each of them, and that's not scalable and not transferable. And now you're switching over to Web3, where you have access to 17,000 protocols, and they could all be market makers, lenders, or borrowers. So the whole sort of KYC, investor suitability, onboarding processes is not scalable in this decentralized paradigm. But one thing that we are solving for at MetaMask Institutional is to be able to hold a verified credential within your wallet that proves your suitability. It's almost like a badge that says, I'm a qualified institutional buyer, I know what I'm doing, and therefore I can engage in certain investments that, that I qualify to do. Or I'm a high net worth individual, or I'm an accredited investor. So there are different credentials that do not hold PII data in your wallet that can interact with protocols to lend, borrow, hedge, stake, or whatever it is that you want to do in Web3.
Yeah. Well, thank you. So we need to come to an end now. So what I would like to do for the final round is just one sentence for all of you to kind of take away, or key message for you, also for the audience. So my key sentence is regulation of DeFi is a contradiction on its own. I hand over.
Yes, yes, yes. In my opinion as well, in some way. One way that I see on the other side is what could happen as well is that the entry door into the whole space gets regulated somehow, but inside the space itself, it's still like some kind of freedom of use. But the entrance and the exit of the space, I think, is somehow regulated already. So it's moving towards this topic anyway. But yeah, it's somehow a contradiction, because if you are talking about regulating DeFi or regulating Web3 as itself, yes, you're contradicting something, because when something's regulated, when something follows rules, it's not real DeFi anymore. And at the same time, if something doesn't follow the rules, it's not compliant. So I see some challenge here and there, but I think the solution will be somehow in a mix of both worlds. So the entrance and the exit out of crypto will be regulated anyway. And yeah.
Thank you, yes. Maybe given time, maybe really one sentence. Oh, sorry.
So I think what the future probably holds is a mix of the Wild West decentralized finance that ideally retail has some access to, and then we'll call it hybrid DeFi, where platforms can exist that institutions can get regulated access to, which is great for those markets as well. And fundamentally, it's up to the communities behind these projects to decide which direction they want to go, or how much in either direction they want to go, and the technology tools are there to take them in either direction.
Okay, mine will be quite short. I think it would be educate yourself, because there's no right or wrong where you want to park your funds in, because ultimately it is still your choice, and no one's going to look after you, because you look after yourself and how you're going to finance your investments, and that's it.
I can't add anything. I think you've covered everything, but I'll just say watch this space. It's still evolving very quickly. If you want to know more about MetaMask Institutional, please go to our landing page, come by our booth, come say hi. Happy to engage. Thank you.
Great job, everyone. Thank you so much. Give it for our panelists.